Welcome to How I Met My Broker by Strategic Brokers, where we uncover the stories, strategies, and insights of individuals who've built significant wealth through smart leverage. Get ready to learn, be inspired, and take your property game to the next level.
Well, g'day, once Liam Garman here, editor of Smart Property Investment, back today with another episode of the How I Met My Broker podcast with my co-host, Gordon and Chuy, talking about all things buying mortgages in property investing from Strategic Brokers. Hung, how you going?
Yeah, going good, mate. How are you?
Good. We've got a pretty good guest in the studio.
Oh, mate,
today.
super excited to have Sammy G on the show today.
Sammy G.
Gordon.
I think the only person in Australia that probably does as many property podcasts as I do. Sammy
Mate,
Gordon.
Probably, boys. It's good to be in here. Obviously, Hung and Liam, but boys, you're two good mates of mine as well. So I'm excited to jump into this today, man, and have a bit of fun with it as well. So I know you boys have got some loaded questions for me, so we'll see how we go.
Yeah. Well, the first loaded question is, on this podcast, we like getting into how our guests met each other.
Yes,
well,
for sure.
How you met Hung and how Hung met you, because there's always a different story. And I think, in this space, sometimes, there's egos involved, maybe not. But as a quick teaser for the next hour, we're going to be talking about building a mega mindset. And I think there aren't many investors in Australia with the mindset that you two both bring to this, both from the broking angle, from the property investing angle. So we're going to be hand-holding our listeners through how they can build a mindset needed to build a 20, 30, 40 property portfolio. Jumping straight in, Sammy Gordon, how did you meet Hung?
It's funny because we're kind of semi-talking about this off air. You boys are having a bit of a laugh because I feel like there's a different story it's going to come across here. But it was like trying to probe the mind, trying to remember exactly how it came together. Man, I think it was something on Facebook or Messenger or something like that back in the day. Either I've messaged Hung or Hung's messaged me. I can't remember if it was about the McLaren or what it was about back in the day. But it was. I feel like it was something to do with Messenger. And then we just started chatting. And the funny thing was, the deeper that we got, we realized that we actually grew up really close. Well, I went to school really close to where Hung is from, like originally in Western Sydney, and then man, very very similar journeys, very similar paths, obviously different, but then very similar as well. So it was cool, man. It was cool, and obviously we've been good mates since then as well.
That was a pretty diplomatic answer.
No,
I don't know who
good.
hit up. What's your side of the story?
No, look, the story isn't far apart, I feel. I think the things that I was kind of like that guy who was trying to slide into your DMs for a while. So I was like, I think a while back, I think APS fell on the radar when I started looking after a couple of clients.
Yes.
I think a couple of deals fell on my desk and I'm like, oh man, that's a good deal. I'd buy that deal. So it just kept happening more and more frequently through the journey. And that was over a span of a couple of years, but I didn't really think to reach out. And I think one day I just started sending fire emojis to him and stuff like that.
You up texts, 2 a.m.
And then from the fire,
The 2 a.m. drunk text.
I turned around and liked the photo from 4 years ago.
That's when I blocked him.
And then quickly unliked it. It became a whole thing. I like that side of the story because I was so sure, when I said ego, I was so sure that you were going to try and blame and say, no, I wasn't the first person to make the first move. Because that is actually the story that Hung's told me in the past, which is, I hit up Sam's DMs. I'm not going to lie.
Yeah, I was trying to get in
funny.
there, and I think the trigger point was funny enough. I know it's not materialistic at all. It's just that we both love cars,
For sure.
Yeah.
and sometimes it just takes a connection. Like the love for cars brought us together,
Yeah.
and then we eventually just started chit chatting, and our synergies were they're just going off the charts. So it just kind of worked.
Very aligned, man. I think
Yeah.
it's funny. I've forgotten that part of it. And I think when you're in the space, obviously you become reasonably well known as both a buyer's agent and an investor and advisor, sort of within our space and what I do. And you get hit up a lot from brokers and whatnot, right? And I think it's I think I took notice properly of when the cards did come into it, and then I think I looked at you. And I looked into the page and I realized, okay, this guy actually is pretty serious in terms of what he does, and he's got a portfolio, and that's something that I'm massively respect, obviously, people who walk the talk. And so Hung's been investing for a very long time. And when I realized that sort of connection synergy around that, actually both being property investors and the love of the cars that came into it as well, it's just like a mutual sort of respect that comes into it as well. You think about it, there's a lot of people that jump in the game, whether it's for broking, counting, buyer's agency, or the rest of sort of thing, that don't even actually invest. And when you realize someone's walked the talk and built it over a long period of time and got the scar tissue from it as well, you know there's knowledge and experience there that a lot of people don't have. And then respect is something that has to be earned, right? Respect isn't just a God-given right. I don't expect respect from people. It's one of those things, in my honest opinion, that has to be earned. And yeah, man, like it's one of those things. When I got to know Hung's story, it's because I'm very close circle, you know what I mean? I don't have a massive circle. I'm not trying to rah everywhere. And I think when you learn that someone's been through it and walked that talk and got that scar tissue of 20 plus property portfolio, you don't go through that without a few cuts and a few wounds on the way through as well. So yeah, man, it was cool. It was cool.
100%. I think that's going to be the first thing that we're going to talk about. And as a bit of a segue, and this is something both of you talk about a lot on your respective podcasts, which is for investors, the need to surround yourself by good people, whether it's a good broker, a good accountant, a good BA. Any link in that chain is a weakness, and the chain's going to snap. To start off, Sam, you actually got burnt by your first BA. I'd love to get a little bit of insight into that and how that kind of started your passion for being a good BA.
You're gonna get Sammy fired up here.
Yeah, fuck. It's a funny thing to dissect because it was the hardest thing I'd ever sort of gone through at the time, especially financially. But it was also the most formulative, and yeah, man, the way it really sort of shaped my moral compass as a buyer's agent over time, but also put some serious fire in the belly when it happened to me too. And to tell the story, I was about 26, 27. I think I was 26. I was making about 70 grand a year gross. I was netting about 55. $10,000 was a lot of money to me, and I'd built a 7 property portfolio at the time. I went and saw a bunch of different buyer's agents that were really well known and respected in the industry, and the feedback was that you're doing really well, mate. Like, just keep doing your thing. You're doing really well. Those deals you've bought are really good. They're performing really well. You're managing your cash flows well, all the rest of it. Until this one guy who I left to the end, who was my idol at the time, and he just rubbished the portfolio. And when he rubbished the portfolio and ran through it, he goes, man, our deals are so much better than this. I was like, holy, everyone else has said, you're doing really well. This guy's deals, who I'd already put on a pedestal, I thought, this guy must be a machine. He must be a beast. And so I bought into the hype, and you know, as a silly young fella, I didn't do the proper DD or research on it. I just trusted this person, and man, one of the biggest red flags, you sign on and then you get deal sent to you straight away. So if any buyer's agent is doing that, it's an immediate red flag, you know. And man, I was just getting spammed with these deals, and I was lucky that I had enough experience as an investor myself that I'd been through the process before and knew how to look for value. So I'd always looked for value, and I was getting sent these deals or off market, but I was finding deals on market like 30, 40 grand cheaper than what I was being sent. I was like, man, this doesn't make sense. And I've just sold this deal to free up my borrowing, and now you're sending me this stuff that's even more expensive with a worse yield with, 10 grand a year body corporates in this unit comp. It just didn't make sense. And I was like, man, what's this stuff? And he's like, oh, blah, blah, blah. And then he just kept, fugaziing the situation. And then, after 6 months of that, I ended up pulling the pin on it. Told him what I thought, moved on, and then yeah, man, it put the real fire in my belly, and I went from 7 properties at that sort of time back to 6, and then I shot up to 20 properties in around about 18-month window. It just put the fire in the belly to really go hard and to give him a, sort of give it back to him on that side. But then yeah, man, then it really formulated into the moral compass that I have now in terms of, clients coming in and want to make sure we do the right job by them, because you never know who that next 26-year-old is that you might burn, and then you put a chip on their shoulder to then come after you one day. Oh, like I had that on mine. So, but not only that, you just want to do the right thing by people. There's always money to be made, but it doesn't mean you can't do a great job by people as well. So, yeah, man, I'll never put profit before that. And every day of the week, I'll always, we're always pushing to do good deals, great deals as often as we can. Even look at Hung, before he even knew who I was, these deals were coming across his desk that him, with the amount of transactions that he's seeing, goes, I would buy this deal. I would buy this deal every time a deal came across the desk. That's what we want people to look at deals and think when they think of APS and they think of myself. So, man, I can't take the negativity around ever doing a bad deal. Like it's always bad taste in my mouth if anything ever happens with a deal, breaks down, building and pest, those things, man. Like I always, put my money where my mouth is to make sure that people are looked after as well as they can. So I don't know, man. I don't know whether it's not a fear of bad karma or just
perfectionist, right?
It is,
like
man.
you
It
hate.
is.
Yeah, it's like a tradie like looking at a bad job
Yeah.
they've done, and they're like eats them up inside.
Bro, seriously,
Yeah.
it does. It does. I don't know. I can't walk around with that knowing that I had done a bad job to someone because that had been done to me as well.
Oh, 100%. Hung, do you have anything to add?
Well, similar to Sam, when in my early days when I first started investing, the fire in my belly got put in there because I bought a couple of bad deals, right? And those bad deals presented themselves because they were off the plan deals in the very, very early stages of my property portfolio building. I reckon that set me back 10 years, like just purely on these 2 or 3 deals that I purchased when the opportunity cost was there to buy much better deals. And that would have, if I had got it right on the first couple of deals, I could tell you I'd probably be another 50 properties ahead right now, without a doubt. You know, it was that mental strain, that loss of opportunity costs.
Those early deals, man, that velocity of money, you get the first couple of deals wrong, mate. It can set you back literally a decade.
100%, 100%. And that's, I guess, what I vouch to not allow people that come through my business to ever experience. So every time someone comes into my business and they present to me a deal like that, I look at it and go, I'm not the person to tell you yes or no to the deal, but I can state facts, right? You are looking at buying a unit. There's 400 in this complex. Comparable sales about 40% below that. Why are you buying it, right? So I'll just state the facts to them and they make the decision, right? So that's what we do in our business. And I think that's what separates our business apart, is that we're willing to have the hard conversations with people to say, hey, you know, you've fallen in love with this thing, but is this really the right deal for you? Let's look at all of the different variables and then you guys make a decision. And, you know, 99% of the time, they will change their mind. And then I'll do, I think, the right thing. And then we give them all of the education. The reason I started this podcast was actually to help people like that, you know, that are really lost, because I didn't have that going into the property game. And I only really started understanding it when I started tuning into these podcasts. Like Sammy's podcast helped me a lot. I didn't know where I wanted to stop at times. And then this guy went to 134 properties. Like, what the hell? I think something in my brain said that's just too much when I first heard it. But then when I started processing it and started breaking it down, I'm like, actually, you know what? I could do that. You know, so I think, look, kudos. I'm not trying to blow smoke up here, but sure. You've actually helped me kind of overcome limiting mind pieces, like things that I thought that weren't possible. So.
There's 3 things I want to touch on real quick with that. First one is like that synergy piece we were talking about. It's the same thing as like the right deals going across. I think that's where Hung and I really connected around that side because of it. And we talk about the synergies that sort of came when the cars and we started chatting. It's funny how much sort of came off the back of it because there's similarity in the way we think about deals as well, which is mad. I love that. Second piece of it was the velocity of money in the early phases, right? And it's something that people really need to understand. Getting your first deal or your first couple of deals wrong can literally cost you 10 years in the market. It's funny because I look at now where I am now and people hear 134 properties and they think that's crazy, right? What a lot of people don't realize is I had 5 years in my portfolio. So I bought my first property at 19, second property at 22. I didn't buy the third property until I was 24 or 25. There's like 5 or 6 years there that if I'd known what I was doing or I was being led by the right person, I could have massively scaled beyond that. Like I look at where I'm at now, I missed most of Sydney because I was incorrect with the deals that I bought and I didn't have an advisor or I didn't have someone, a mentor guiding me through the process. And so that's where I could look at it now. And like I did in 5 to 6 years, 2 deals, which I did well in because they were in Sydney. But imagine if I was led by the correct person. Like I look at now clients coming through. Hung's seen this with our clients, our young clients. 1 deposit within 12 months, they're 2 to 3 properties in. Within 2 years, they're 4 to 5 deals in. Build a 2.5 mil asset base. You carry that through a growth cycle in your second year on. Imagine where you're getting to in that time frame. You know, and people say to me now, they're like, "Oh, you know, you couldn't do what you've done." Look, mate, I've been doing this for 16 years to get where I am. Imagine if I got the first 5 or 6 years right. That compounding effect of getting it right and getting it correct, man, it's an absolute game changer. So people, they cannot underestimate how important that first, second, third deal, those foundational building blocks are absolutely key. Third thing I wanted to jump on was Hung saying around the 134 properties and how crazy it is. Ultimately, when it gets to that sort of level, what you have to realize is your portfolio is a business. You have to treat it like a business. And people hear that and they think it's crazy because I can manage 134 different property managers. No, I don't, because most of the time when I enter a city and I buy in a location that I'm super bullish on, I'll buy 20 to 30 properties there early in the first, let's say 6 to 12 months in a cycle. So like it sounds crazy, but it might be condensed down to 10 locations across 134 properties. So it can be very, very different when it's broken down like that. And the cool thing as well, going through a bit of consolidation, buying commercial, which has so much less headache and risk around it and everything as well, offloading some resi deals too, it starts making it a lot easier too. So it's cool, man, but it's all part of the game. The other thing too is not everyone needs a 100+ property portfolio. You can build a ridiculous passive income without needing to go anywhere near that sort of level. 20, 30, 40 properties, you can build a ridiculous lifestyle off the back of a portfolio like that.
I'll probably just add a note to that also is that, look, if not everybody wants to get to that level, but everybody wants to get to a level of freedom, right?
Yeah.
And if they're dreaming, I guess if you put it from the beginning, not just, I guess, having the right advisor, but getting the right structure. I'm just going to throw a bit of finance in there because if you get the structure wrong from day one, you'll stop at 2 or 3 properties. You know, if you're not thinking about exiting markets, which, you know, there's a lot of guys out there who are just like, let's just buy
and hold forever.
And let's just hold forever.
Terrible
right?
strategy.
It's a bit of a marketing fugazi.
I love it.
We had to drop the fugazi in there, right?
It is.
So,
I think that's the second one. I've already dropped one.
You dropped the 2 fugazis. How many fugazis we're going to get through
How
here,
many
right?
fugazis can you do?
But I feel like it's a bit of marketing fugazi because people are just thinking, these guys are just trying to market to you to say, hey, you know, we're just going to buy you property and hold it forever. But the guys who are actually building a structure or strategy and then, you know, offloading a few properties, cashing in, reducing debt, buying again, these guys are going to get a whole lot further than the guy who's just buying blue chip, hold forever. You know, so,
And you can bring those plans forward so much quicker too. It's not a 20, 30-year game plan anymore. It's a 7 to 10 years realistically. And this is where it's like, depending on your goals, depending how big you want to build a portfolio, 15, 20 property portfolio could probably build you, 300 to 500K net passive. If they're the correct assets you're putting in there over time, consolidating, exiting as Hung's talking about the correct times, buying the correct cash flow assets as well. Like you think about it, 15 to 20 properties can get, let's say 20 properties over the course of a 7 to 10 year cycle, in terms of a buying cycle as well, being an active investor over that time frame, you realistically be able to build a 500K, depending on the size of the assets you were buying, passive income in that time frame for sure. But it's about exactly as we're saying there. First one, obviously buying the correct locations, the right property, right location, but then creative lending and building that finance piece around it is so important to get there as well. It's probably it and the deals, 2 most important things.
I'll probably roll something else rolling into that as well. So like Sammy and I have, we've done a fair few clients together and I've been on the floor in the trenches as well. So I've seen what the deals look like, how to build the strategies. So what I've noticed, which is different for Sammy versus everyone else out there, he builds out a proper strategy in the sense that, well, you need to go through school of property, right? Which is the fundamental background of what is required to build out these portfolios. Nobody else out there in the marketplace has a school of property. And if they do have something similar, it's nowhere near this level. So I could tell you hand on heart, right? I've got clients who come out of school of property and they're more sophisticated than probably 90% of your buyers agents or brokers that are out there in the market.
Yeah,
they're
for
actually
sure.
everyday people who know more than all these guys who are meant to be the professionals to tell you exactly how it is that you're meant to do things.
For sure.
Yeah, which I find amazing. So just want to kudos to that.
No, I appreciate it, man. It's in my opinion, it's a game changer. It's almost everything between the years that I've had up here that I've built over the last 16 years. And it really does empower people to know how to actually build a portfolio. Because at the end of the day, Australian Property Scale, we can't work with every client. But if we can equip, every investor in Australia, and a lot of investors out there want to do it themselves anyway. But if we can help arm those people to actually achieve their goals and achieve what they want to do from property and learn how to do it as well, man, I'm happy to help as many people as I can from that side too. So I love it. What are we up to? It's like 100. I think I'm at 120 odd lessons in there now too. And
120.
yeah, man,
nice.
I do the monthly webinars that are circa 2-3 hours long each as well, where all the students come in, they fire all their questions. I can run through everything from a strategy perspective. So I love it, man. It's mad. It's hectic.
Yeah, you touched on something before, Hung, which I thought was really interesting. So the way that you reached out to Sammy was, you saw all the deals going through. Oh, who is this guy? Like, what's actually happening? Like, this is standout. For people that are listening to this that might be unsure about their BA or might be unsure about their investing journey, but their broker isn't giving them, say, the insights that you're giving of like, hey, like the market comparison here, this isn't a good buy. What are some of those characteristics at the moment that you're seeing from people come through, which make you think, oh, I don't think that's a good investment property to have? What are some of the standouts?
Yeah, so one thing that I know Sammy does better than pretty much everyone out there is he looks very hard at intrinsic value. So a lot of people who are buying investment properties, they're not looking at, no, they're not digging deep, right? They're just looking at a property and going, oh, okay, this one sold down the road for X amount or whatever it is.
Okay, very surface level.
Yeah, very surface level, right? So like some of the deals I've seen Sammy put up, he might buy a property for say 650,000. And when I look at that deal, I look at, okay, what's vacant land sell for in that area straight away? And I go, well, that block would sell for 650 grand. And then we go, well, wait a second, you're getting a free house.
Yeah.
So that's how I look at deals a lot of the time too. So I'm looking at it going, well, you know, what's your worst case scenario? The worst upside you're going to get is that you're going to get the value catch its normal price without any emotion inside of that, right? The best case scenario is you're going to get it, the market's going to go beyond what its intrinsic value is, and then those emotional buyers start popping in, and then all the owner occupiers start pumping the market. And then that's a telltale sign usually for myself that maybe if you wanted to sell, now's the time because you've passed intrinsic value. I'm not sure how Sammy's take is on that, but yeah, that's what I've started to see in the deals. And then also the cash flow side of things, right? You don't want to be buying deals which you're just burying money into, you know, because the reality is when you buy an investment, you're buying it to make money. Yeah. You're not going to a barbecue to tell your mates, hey, I own a property over here and best property in the world. Yeah, it cost me 40 grand a year to hold this property. I made 200 on it. After 5 years, you broke even. Yeah. And you lost energy, you lost time, you lost opportunity costs.
Hair.
You know, lost hair. But I'm saying, like, with all of that in mind, that's you know, so that's what I noticed was the core difference. Especially a lot of the markets that Sammy will buy in, they do obviously that intrinsic value thing. They also in a really good rental environment where there's a lot of pressure on the rents, which means it might not look the prettiest now, but let's give it a year, 2 years, you might see that rent increase quite dramatically. And because I'm constantly I love this stuff. So I'm looking at data every day. I'm always looking at property. So I'm like, wow, okay, that area's look.
We're going through three settlements at the moment.
I've got 3 settlements.
I'm just on the burner.
No, I'm constantly buying. Yeah, I think I'm trying to catch up to Sammy, but
speed it up then. You did have a win that kind of started your secret sauce, your Da Vinci Code for that rinse and repeat. Can you talk us through that win?
Yeah, for sure. I mean, like early in the journey.
Yeah.
Yeah. So as we kind of touched on earlier, like I kind of had that first deal I bought at 19, bought the second deal at 22, and that was a buy and build. So I bought the land in 22, built in 23, and I did well out of both deals. They were growing really well, but the cash flows were very, very average. And whilst I was getting an equity gain from it, specifically where like I made equity on the way into the deal, especially the build. I think I made about 150, which was mad. And this is going back 10, 12 years ago, like 2012, 2013, something like that. Market started to pump. There was growth coming through, which was great. But what I found was I knew I was going to run out of serviceability. Like my serviceability was running out. And what I was doing was really researching in all that time frame. Whilst I had that dead time and there was like sort of 5-6 years out of the market, whilst for me personally, it was a time where I didn't like grow the portfolio really outside of the equity growth that was coming through from market movement. What it enabled me to do was be very hard on myself that I'd bought the wrong deals from an ability to move forward more quickly. So it made me research the strategies or research all the strategies that I could to find out what was really going to work. And the beautiful part is now that pain that I went through in that period of not being able to grow the portfolio, now our investors get the benefit from that because obviously the learnings that I went through and implemented and applied on my portfolio. But effectively, what I realized was I needed to target markets that were at a cheaper price point than what I was currently buying and where I currently bought with a stronger rental yield in markets that I thought had good potential for capital growth. I needed to buy them below market value. And for me at the time, I needed to renovate them because I needed to force even more. So if I could buy them at about a 10% discount at the time, which was a lot of flat markets. So if I could target a flat market that I thought was going to grow, buy at a nice discount and then add some value from a renovation perspective as well, that was perfect for me. So I kind of went into this cadence of buying every 3 to 6 months because I'd buy really well. I'd then I'd let the tenants vacate at the end of lease. I'd go to that place and I'd take 1 or 2 weeks leave, like holiday leave, and I would renovate the property. So
not for everyone though, which is what we'll talk about on our last pod. Not for everyone.
Not for everyone, but for me, that was my strategy that I went down. And so I'd sleep in a tent out the back and I'd renovate for like 16, 18 hours a day. And then I'd just go sleep and then I'd go back to Bunnings first thing in the morning and that was my process, man. And that's what I did that.
The body would be very
for 7
sore,
years.
like sleeping on the ground and then renovating all day.
Dude, I was a laborer for 13 years before I was ever a buyer's agent. So I was used to working hard.
Yeah.
I did scaffolding for years. I was literally working on the farm laboring for years. years. So it is what it is, man. I'm from the bush, so like I've gone camping heaps of my life. So it was, I don't know, it wasn't that bad. I kind of enjoyed it, but I was roughing it, man. But I did that for 7 years. The only component you would need to take out of that these days that we don't do for clients, or like we don't recommend typically for clients, is a renovation piece. Yeah. But everything else in that strategy, you talk about like the Da Vinci Code, we kind of call like the APS methodology, and what we try and apply for clients when we secure deals. We still try and stack all those things in the correct cadence for clients. And some clients still go out there and renovate, but all the time they don't need to. And if you're buying in the right market that rapidly starts to move, you don't need to do the renovation. And a lot of the time, the clients are better off retaining their servicing, not cooking themselves with a reno that they probably don't have a skill set for, and just focusing on keeping the serviceability strong, structuring the deals correctly, and then selecting correct assets so we can retain servicing as much as possible, but then also have that equity that we can pull out and keep moving forward. So it's powerful, man. When you do it correctly and you keep rinsing and repeating it correctly, then you're sweet, man. It's powerful. Keep moving forward. Keep building the equity base.
I think we were talking about it last time, where one of your clients, they end up having a 6-month renovation, and they kind of factored in 2 weeks for it because it's very easy to make mistakes. It's also super easy to over-egg how much you're actually capable of in a certain time frame.
Especially if you don't have the skill set. You know what I mean? That's the biggest mistake I see people make. And I've made that mistake myself as well, where you go and you think you're going to be able to do it in a certain time frame. Whatever time frame you put on a reno, if you've got no experience, like probably triple it. And whatever budget you put on it, probably at least double it. Like in all reality. And for some people, it's a really good learning curve to go and do it and experience it. And then if they want to apply that to their strategy moving forward, it can be a great strategy. But for most, man, it's not. Leave it to the side. Don't do it. And that case in point, client in Perth thought he was going to do this renovation in 2 weeks, took 2 weeks off work, got about 20% of it done, and then over the next 6 months cooked himself by driving down there from Perth down to, it was about an hour south, where he would drive down, do this renovation every night and drive back. Every weekend he was there at Friday over, renovate the whole weekend. He was cooked, man. His relationship almost broke down with his partner in this time frame.
Untenanted as well.
Man. So like the time frame of doing it just didn't make sense, after the fact. So
one of the other things that like really hamstrungs people, Hung, is the creative lending aspect or the serviceability aspect. Can you take us through the lending, or maybe it's a conversation for both of you, from zero to a property portfolio over 100, and the mindset that it takes?
Yeah, so I think Sammy went through it, and I think he shared before that, he had a previous broker before he moved on to his current broker. But during that period, I think the broker that he was dealing with very likely just didn't know. So, and it's very, very likely. Probably only 1% of the brokers out there who actually understand what it requires. And there's probably 1% of that 1% who actually understand the strategy, right?
Sure.
And maybe less. According to standards, it might be 5. No. but in saying that, it's you are going to be capped either way if you don't think about whether you're buying in entities from the start. I don't think we'll dive too deep into that, but I think the idea of it is to buy in entities, but you have to have a game plan with it. Not just buy and try to keep buying in those entities. You got to think about what assets you're putting in there, what's going to cash flow in there, what might be sold, and at what given times is going to allow that entity to deem itself profitable, start making its own profits, so then you can keep building from there. So there's a lot of thinking that goes into it. People think, don't you just put it in the computer and give you fines? No, we've got to think exactly which banks we're using today. Policies are changing every day. Might not be the case tomorrow. So we got to think about what's the other options if this changes. So it's all about adapting constantly. So there's guys out there who will give you a fugazi game plan to say, hey, we're going to build you out in the finance piece anyway, all these properties. But the truth is, finance is a adapting game where you have to keep changing to the environment. And I could probably go back to COVID times when I know Sammy, that's probably his Da Vinci Code. Now, the reno part was obviously all well and nice, but that's not the Da Vinci Code. That's not what allowed you to go from 20 properties to 134. When he figured out that opportunity cost of renovating, and that was like a waste of time, like you were saying, right? And he figured I could just buy a property in a growth market and not do anything. And actually, because of the time that I don't have to invest in that, I could go buy another deal and another deal and another deal. And that's probably the Da Vinci Code that cracked it and got you past from 20 to 134, because you've done that in a pretty short time. Yeah. Right? It's funny because once you find that formula, then you just start running. Yeah. And I personally went through that journey of I was a scattergun for quite some time. Tried to develop, tried to buy into hotels, try to do this, done everything. I thought developing was the way to go. And then as the construction prices went up, it was good. If you went back in time, developing was great because the price of materials was so cheap. You could build anything and make money up until I can't remember the year, but coming in, it would have been just before COVID. You could literally have taken a piece of dirt, built anything, and you would have made money. And because construction was so cheap, it virtually doubled in price since then. So if you try to do a feasibility on any deal now, it doesn't make sense.
I'll touch on two things there because I know you said about the mindset piece. So I'll touch on that in 1 sec. And I think that there's two things to sort of pull out of it. The second piece will be the mindset. The first one is around what Hung was saying there around the Da Vinci Code and kind of changing as well. And I think for me in my 20s, so obviously, I'm very lucky. I'm born in 1990, so every decade it's a very clean decade for me, right?
It's very easy to do the math.
So easy, man, so easy. And so from 2010 to 2020, that was obviously I was in my 20s for that whole decade. And for me at the time, my servicing and my borrowing was so low because I was on such a low income on PAYG for almost all of it. Think of it when I was 26, I was making 70 grand a year gross, right? I wasn't even at the average Australian income. So for me, the Da Vinci Code in that phase of my life was to throw the renovation as the bolt on to make an extra 10% of that time frame. But the reason was because I was on such a low income. If I was on a different income, which most people listening to these potties these days, like realistically, most people, so many clients coming through in their 20s are making 150 grand now. You know, it's so normal for a single person to be making 150 odd $1,000, whether you're 100 to 200, say as a range, households between 200,000 plus, right? That's a lot better servicing than when I was on the 70K.
Yeah, without a doubt.
You know, and so the difference in phases of life for me, the difference was when, and it wasn't even from an income perspective, because the funny thing was when I first entered COVID, I was only 12 months into my business and I wasn't even making good money, right? So, but my portfolio was there producing good income. So I'd replaced my income at circa 28 years of age. So 2018-ish sort of thing.
So your business is in APS. So you started up by that point.
Yeah, so I started APS in 2019. In 2020 was when in 2019 I made no money, right? So I literally did virtually no deals in 2019. I grafted, I tried to do everything I could, but it just didn't take off, right? In 2020 things started to change. I started doing okay, but it still wasn't great. But I was in like first year of financials of the business was pretty much, if anything, it was a net negative. Like there was no borrowing capacity with that, right? But what changed, where the huge difference was from my 20s to now in 2020, I turned 30. Beautiful, so easy to remember from the maths. But in 2020, I turned 30. And I was now in a different phase of my portfolio. And it wasn't the income phase that I'd built. It was the equity base. So I'd gone through my whole 20s building my equity base, figuring out how to preserve my borrowing capacity because my borrowing and serviceability was so low because my income was so low. And then what happened was I got to this point and I built I think I was sitting on around $3 million worth of equity, right? At that time, usable equity. And so what happened for me in that time frame was I actually switched to self-employed at that time. And so I've lost the full time and people are like, oh, we had the business, so you're making so much money. Brother, I wasn't making any money. I wasn't making anything. And I swapped to self-employed where my serviceability was shot. And that's where I had to figure out the next phase of lending from like a low doc, these sorts of avenues. I was low doc in my portfolio, man. Everyone was borrowing in COVID in the 2s. I was borrowing at 6%. And so we talk about, and that's where I'm leading this into mindsets. There's two pieces here. The first piece is I moved into a different phase of my journey, a different phase as an investor. And that was a very heavy equity-rich investor. So serviceability was now almost out of the window because I was doing a different lending product to what I'd done in my 20s. 20s, I did what I had to do to get money and borrow money, but I had serviceability from a PAYG income. Entered my 30s, I'd build this huge equity base. What happened was, went into 2020, and this is the mindset piece that Hung's sort of leading into here as well. Went into 2020, and you guys would remember, I actually did a podcast with this with Phil in COVID in my parents' tiny little fibro shack down the coast. Green walls behind me if you guys want to look this thing up. And I remember I was the only person that jumped on SBI with Phil and he goes, why are you still so bullish? And I'm like, man, there are so many markets around Australia right now that have not grown in 15 years. You cannot tell me that those markets are going to drop in value by 40%. I don't believe it. I think everyone's wrong. I think the people who need to sell will sell. The people who don't need to sell will take their properties off the market. I think we're going to go into a stock deficit. I think we're going to go into a massive boom. And Phil's like, are you serious? And I'm like, yeah, man. Like, how does that not make sense? Like literally, that is what I firmly believe was going to play out. And
You were the last man standing at that point.
man, everyone was like trying to take they were trying to go like real passive, like, oh,
100%.
let's sit and wait this thing out. And I'm like, nah, and put my money where my mouth was, man. I did a massive equity release on the portfolio. I paid ridiculous interest on it. I set aside a nice buffer that I knew I was going to be able to carry the interest in my portfolio for the next 2 years. And this was me personally going, this is what I need to do to move forward. I'm going to roll the dice. I'm not making that much money. Just got into COVID, so I got no clients. There's all these mad deals around. I bought 11 deals in something like 8 months between, it was about May 2020 to the end of 2020. By the end of 2020, I was probably up 100 grand per deal because the market turned. Because what happened was everyone that needed to sell sold at hectic discounts. Everyone who didn't need to sell didn't sell, pulled them off the market. Massive stock deficit. People couldn't travel, especially a lot of young home buyers and investors and whatnot. Bang, went into the market, it went crazy. Yep. And so almost all those properties now that I bought in 2020 have tripled in value in that time frame from rolling the dice.
What locations were you looking at?
Brisbane was a massive one.
Yep.
So 2020, I was very heavy in Brizzy. Those 11 deals, all in Brisbane. I bought all of them between I'll put all of them between 190,000 and 320 was the most I paid. Oh. I just sold the one at 190. I just sold it for 625.
Looking back at those prices now, that's insane. Hey,
crazy, man.
Yeah,
I literally paid 190.
Yep.
Sold it for 625.
Yep.
That's more than tripling, right? But it's like, and I don't say that to brag. I say that as rolling the dice in that time frame in a ridiculously hectic period. It was obviously a different mindset that I was willing to I guess embrace and go down. And for me, it was going all in. And this is where my question to people is like, if you're not going all in, like, what's the alternative? What else are you doing? And that's where I really look at it. It's like, what's your other strategy? What's your other game plan? What else? I got a little bit in share, whatever they're doing, or like, oh yeah, I'm doing this or whatever. It's just like, in Australia, the vehicle that we've got that is the most, like, we can leverage so hard, put 100,000 in and turn that into X amount in 12 months, 24 months, whatever it is. That's why I looked at it and I'm like, this is an opportunity right now where no one wants to buy. I was buying properties at 10 to 20% discounts in a capital city, 20 minutes from Brisbane. And I don't know, man, sometimes you have to sit there and really look at the facts and look at it as almost like holistically of like, what's the other alternative? What's the other option? It's like people talking about now, well, the market's cooked. It's like, what are the other alternatives? You sit out for another 12 months. I guarantee you're going to look back in 12 months and go, I should have bought that deal. You know, and so that mindset piece, it's almost like it's weighing everything up. And people, it's funny because like some people think I'm probably a big risk taker. In all reality, I'm probably one of the most calculated risk analyzers and assessors before I pull the trigger on something. But then when I wholeheartedly believe in it, I buy 20 properties in a market. Because if I've assessed it completely, then I'm so, and this is where we were talking about school of property before, and knowledge is power, but also, it's kind of that experience piece, but it's like once you do that and once you've gone through and once you've convinced yourself of something and there's no other alternative, like it makes so much sense. Why just back it? That's why when people want to buy our deal and then sit there and go, I'm going to see what happens in 12 months. Well, if you're going to buy our deal, you may as well buy 2 deals. You got the capacity, you got the capability. Because what if it does 20, 30% in that time frame?
And then you foregone an extra one.
100%.
Yeah.
And so, man, this is the way I just like, I look at it like that. And for so many Australians out there, property is an unbelievable vehicle to build wealth, to embrace leverage that we can't do almost anywhere else. And man, it's just like, it's that vehicle that you can genuinely be an average Australian income earner. Think of the portfolio I built, and I won Investor of the Year before I was ever a buyer's agent. And like the portfolio I built in that time frame was as an average Australian, just understanding leverage, willing to put my balls on the line with deals and roll the dice, man. And I'd love to be able to inspire the next generation of people who are sitting on the sidelines, sitting on the fence, trying to make a decision. What are the alternatives? Weigh up the alternatives. Because the alternatives aren't there, there is no alternative. So get the irons in the fire, man. Start making something happen. Because anything's possible.
Yeah, don't be placid on the sidelines. With this, there'd be strategies on your end, Hung, that allow this, that enable this level of growth. What are they?
Yeah, so I guess on the strategy side, like we said before, it's all about thinking about, I guess, your borrowing capacity is obviously very, very important in this piece. Who you talk to will determine very different outcomes, right? Especially for those guys who are self-employed, like you mentioned, as you was transitioning. And during that time, I think a lot of people coming out of COVID, for instance, they all started to see the writing on the wall and they're, hey, we got to get in. But I think Sam's mindset is different to other people because he sat there and he spent the time to educate himself. So any market he was getting into, like, don't think it's just, hey, oh, look, it looks good on realestate.com. That's not what he did. He literally went to that market, got every piece of information he could on that market. And then when he done his calculations on the spreadsheet and goes, okay, well, look, what's my worst case scenarios? You know, we're a bit psychotic, both of us, because we look at it's the ADHD.
Speak for yourself, mate.
ADHD.
Speak for yourself, mate.
Just bring everyone down.
But I think the way we think, I'm speaking for myself, but the way I think
we're
is,
both there. I'm not around.
If I look at a scenario, I think about like 50 worst case scenarios.
Yeah.
And then after I look at the 50 worst case scenarios, I realize, well, it's not that bad. You know, and I'll go, there's actually, these events aren't possible based on X, Y, and Z. And the most likely or probable event is this. So I do a lot of probability in my mind before I make a decision.
Calculated risk, man.
Yeah. And and as the market you enter, you go, you know, there's some things you can't control and things that you can control, right? If you can control your cash flow, then you know, look, someone's always going to rent this place. If the world falls, then ideally you still get rent. And if it's not burying you and it's costing you hardly anything, you're like, well, wait a second, it looks okay. So I think Sam has a mindset that is different to, I would say, 99.9999, because I don't know anyone else, right, in this time frame who's built a property portfolio so substantial. It takes a certain, I guess, a certain thought process, a willingness to learn, which not everyone is willing to do. Because you might learn a bit and you go, oh yeah, I might, and then you look and then you get busy and then you're like, oh no, forget it. Right? You have to be almost addicted to it, I think, is the key. Yeah,
for sure. There's something else to throw in on that as well. I think one of the huge things, man, is not just conforming to the norm. You know what I mean? Like when Hung runs his scenarios around, like, what's something you're going to play? What's a worst case scenario?
Yeah.
I do that around strategy as well, right? And that's why when we look at properties that cost like 30, 40 grand a year to hold, and people are like, oh, it's just time in the market, just buy it and hold it, and it'll increase by 7% a year. So over, 10, 12 years, it's going to double in value. Mad. Okay, sweet. Well, markets don't work like that. They don't grow at a steady 7% a year for a 10 to 12 year window. So if that market doesn't grow for the next 7 years and you're losing $30,000 a year holding that property and it doesn't move for 7 years, you're $200,000 plus in the hole before it starts to grow. So in year 1 of growth, which is year 8 in your portfolio, you're already starting at $210,000 to $240,000 negative. Like, you've already lost that. So how much have you got to make up before it starts again? Like, where else could you make your money work for you seriously in the next 7 years or the next 3 years, and then roll into a different market for the following 3 years before you actually go into that market for the 7th year or 8th year before that market starts its run? And that's where, like, when we talk about calculated risk, it's not just on a property or it's not on it's a strategy, it's everything. Everything comes into it, because when you assess that, and this is the biggest thing, the way when I look at markets and I look at deals, well, what's the worst case scenario in this? Well, okay, let's say in 12 months it takes for it starts to grow, but it's costing us, let's say in the current market with interest rates where they are, 10 grand a year to hold. Okay, sweet. So we've got a 10 grand a year worst case before the market starts its run, because we're looking at the data. We know how this market's going to play out. And I can say that so confidently now because I've been doing it for 16 years and I haven't got it wrong yet. You know what I mean? Like, timing wise, who knows this from the way that we invest? Timing wise, I haven't got it wrong yet. So it's like, if we know intrinsically that that's going to happen, then worst case, we've got this. But the idea in this philosophy of like conforming to these norms of like these long held beliefs of guys that probably should be just retire, boys, and walk away. Like, let's be honest, this buy and hold approach forever, like, people are just doing their dough on this thing so they can do tick and flick clients. Like, mate, like, it just doesn't, you're not actually helping anyone. And that's what gets me juiced up. We were talking earlier, I'm going to get me fired up. This is the stuff that gets me fired up, because people are legitimately losing money for a 5, 7, 10 year window before something starts its run. It just doesn't make sense. Like, treat your portfolio like a business. If you treat your portfolio like a business, you'll win. That's the difference. The way we do this, when we talk about calculated risk, you're not going to hire an employee that's going to cost you 30 grand a year before they start making you money in 7 years. You're not going to do it. Who's going to do that? No one is going to do that. Why would you do it in your portfolio? There's no difference there. Why would you do that? You would not do it in the business. Why would you do that in your portfolio? Everyone has to treat their portfolio like a business. That is the mindset shift. It's not accepting, oh, this is the norm. This is what everything's been spoken about. This is what people do in Australia. That is so outdated now. Don't believe anyone that talks about that, because it is an incorrect way of investing.
I think it's.
And I'll debate anyone on that.
Oh no,
I'll debate anyone on that.
Well, if anyone wants to come on the
let's
show, I would say 90% of investors in Australia are in that kind of buy and just always hold mentality, right? You know, what do you say to them?
treat your portfolio like a business.
It's that simple.
Well, dude, even let's say you timed a market perfectly and it doubled in a 4-year window. Let's say you bought it in year 1 and in years 4 to 5, it's doubled in value. Beautiful. Bank the profit, sell it, bank the profit. Clear the debt, move on. Because what you're going to do is you're going to hold it for the next 10 years where it doesn't grow. And all right, you might not have incurred on the front end the 30 grand a year, but you're going to incur the 30 grand a year on the back end and hold it for another 10 years. So if you hold it for another 10 years at 30 grand a year net negative, which is actually going to increase because you get an equity release out of it to do, so let's say 40 grand a year. So that means by the time the next cycle starts, you're $400,000 in the red.
You just lost all those gains you made.
100%.
Yeah.
Inflation, not only that, but inflation has also devalued your profit in that time frame. You've lost the 40 grand a year in that, let's say whether it's 20, 30, 40 grand, it just doesn't make sense. Every property in the portfolio has to be treated, this sounds bad to say, but almost like that employee in a business. It just has to, you have to treat your portfolio like a business. You would not hold someone that cost you a significant amount of money. Property is no different. You know, so it's like you have to treat every property, you have to treat your portfolio like a business and make strategic business decisions around it.
I'll probably add to what Sammy just said there is that the opportunity costs of not selling that property is what people don't think about, right? So they're like, oh, look, I've got 6, 7 properties. They're doing their thing. The rents have gone up. But if you actually, this is one point that nobody really thinks about for some reason. You got to look at your actual yield today on the real value of the property, right?
As opposed to when you bought it.
Yeah, so everyone's looking at the yield based on when they bought a property. So when you bought the property, it might have been 5, and now it's increased to 12%, right? But that property value has increased so far. If you looked at the value, it's now 3 point something percent. Could you not take that money and put it into another market, right? And I wholeheartedly agree with what Sammy's done with this whole commercial side of things now.
I was just about to
it's I'm personally looking at it myself, and I've had a few commercial properties in the past. I am still building at the resi side because I feel like I can get to 134.
It's going to post some Sam on your wall.
I just not
double.
I've got a photo of Sam on my wall, and I've got this big 134. But no, I've truly believe that you can then turn that profit into other income streams, and it depends what you want out of it. Like what do you want at the end of the day? Are you trying to get to a level of passive income? Do you have a business that runs and generates a good profit so you don't need that, so you can just keep accumulating? Everyone's circumstances is different, so you're not going to have one fixed and fast model. So that's the importance of getting good advisors around you.
But on the back end of that as well, like even if you're a business owner, like what's your exit strategy? Like you never know what's going to happen with business. And yes, we want to build the equity base first, but we want to make sure there's always that passive income goal on the back end. And I'm just going to quickly touch on something Hung said there. Like, let's say you buy a deal for 500,000, it doubles to $1 million, and your yield now is 3.7%. Now he's talking gross, but let me just give the benefit of the doubt to a growth property, and let's just say it's net, which is not going to be net. On $1 million asset, that's $37,000 a year, right? If you sold that asset and then went and bought a commercial deal, let's just say your baseline rent on that was a 6% net return. You're netting $60,000 a year net income versus the 37 grand in resi. It makes no sense to hold residential growth assets for cash flow over time. So a lot of people, they get hung up on the idea of, I want to have this big portfolio and I want to get to 10. And I actually did challenge a mentor client the other day because they were almost at 10. I go, mate, we've got 3 of these deals that we need to clip. You're running out of serviceability. We need the cash out of them. You do equity releases. We're going to hamstring ourselves. We went through this. We went through the process. We went through everything, with it from the lending side and obviously from the capital side. And he was about to get stuck. He would have hit his 10, but he would have got stuck. And instead of hitting 10, we're at 9. We potentially take it back to 6 or 7. They'll be at 15 by the end of next year and have a significantly stronger portfolio. Hung talks about opportunity costs. We're talking about doubling a portfolio by taking a couple of steps back to take,
But there's that like mental challenge in the way that they don't want to take the step back.
Yes.
Yeah.
Simplest way to assess a portfolio, to change it from a mindset perspective and actually make it almost like irrefutable is treat it like a business. Because what's going to happen, okay, let's say you get to 10, but you're capped. What's that going to produce for you versus taking the necessary steps back to then jump to say 15, or 12 and then into 15 and then potentially, you know what I mean? Like, what are the repercussions of the velocity of money? The opportunity cost. What are the repercussions of holding something for vanity instead of doing the correct things? This ego thing we were talking about before. The correct things to keep building moving forward.
I'm gonna challenge our listeners here. Actually,
this is gonna challenge me then.
I'm getting out of this.
As long as he doesn't pull out the poker cards, I'll take him on anything.
I was like, we'll have an arm wrestle.
Oh man, I am so not on your side with that. It's going to end so badly.
Nah, look, I thought we'll put a
snapped arm. Yeah.
What is it? Wendell? Wendell Sailor? Remember when he slapped that guy's arm on the footy show?
Yeah.
I
He
don't
did the arm
remember
wrestle,
that.
yeah, and Wendell Sailor snapped that guy's arm.
That
on,
is so funny.
Apparently, in the emergency ward in the hospital, the most common break is arm wrestle break.
No way.
So
they
everyone's-
bust
everyone's-
here,
no, you snap here, yeah. like-
Really?
yeah, so apparently,
Should
look,
we-
don't take that
should
as a
we go?
stat, but look at the size of this guy's
I
arms.
don't even believe
it's like,
that.
it's like David versus
How many
Goliath,
people-
bro.
How many times have people arm wrestle?
How many times have we said Fugazi in this episode?
Okay, can I have what is this?
Fugazi.
Yeah, Fugazi.
You know what Fugazi is?
It's from Wolf of Wall Street, Matthew McConaughey, when he talks about something, it's like, it's not real. So it's fake. He talks about the stock market. It's fake. It's not real. It's a Fugazi.
It's a
Yeah.
It's a Fugazi.
yeah. Okay, man, that is not.
Oh, I'm
where
going
my
to give a
mind was
shout out
going.
for anyone that's in Adelaide. One of the best restaurants in Adelaide is Fugazi in the city, and it is hectic. One of the boys that I went down there took me. It's unbelievable. There's this like bread there. There's mad baked bread, and they dip it in the honey and the cheese. It's unbelievable. Anyone in Adelaide or you travel to Adelaide, go to Fugazi. It's awesome.
But hey, back to the challenge. So
The challenge.
Oh, the arm wrestle. All right,
yeah, we're not doing that. We're not doing that. But Sammy said
He stepped
to
out.
look after your property portfolio like a business, right? So one thing I learned over the years is if you hear it, right, and you plan to do it, if you don't diarize it, you won't do it, right? So I'm going to put a challenge out to our listeners. If you do have a property portfolio, let's spare 2 hours, 1 hour, 30 minutes, whatever it is that you choose to do every single week and make that a non-negotiable in your diary. And just look at your portfolio, review what you have and think about your opportunities. I can guarantee if you spend 1 hour per week, that's 52 hours you are spending or investing on yourself or your portfolio to look at it as a business, right? You could allocate more time and obviously you're going to get more results. But when you think about everything that you've put your money into in your life, I would dare say most of our listeners here have made the most money out of their property portfolio than they have working in their lives. So put that into perspective.
Man, I was making $70K a year on the farm, generating over $500,000 a year in equity from my portfolio.
There you go.
You know what I mean? There's a reason why I went all in.
There
And
you
there's so many, we see these young clients coming through doing the same thing, man, earning those same results. That leverage return, that snowball effect. And this is where Hung's saying like around an hour a week. Like if you're starting your portfolio, even just do an hour a month, a non-negotiable, last Sunday of the month, or first Sunday of the month or something like that. Put it in there as a non-negotiable, especially when you're starting. But as you start building that portfolio gets bigger and bigger, you want to have more hands on the portfolio. You want to have more hands, because even if you brought it forward to once a week, as Hung's saying there as well, if you missed 2 of those weeks, you're still doing 26 portfolio reviews a year.
Yeah.
You know what I mean? So even if you missed every second week, you're still doing 26 portfolio reviews a year. Guarantee you 9 out of 10 investors, 99 out of 100 investors aren't reviewing that portfolio that often. That's how often I used to review it. Absolute minimum for me was once a month. I always did that last Sunday of the month. I always checked the statements from the property managers versus the bills. I would make sure, so I had to manage every dollar for cash flow. So to make sure everything was sweet, I was checking when rents were coming up. I would assess what the properties were renting for on market, what I thought I could push for good solid market rent. If it was coming up for a release or if it was coming up for a full proper like open market release or if it was released with current tenant. And it was always these strategic plays and assessing, okay, does it make more sense to go back to market or can I get this, market, $10 below market rent and keep the tenant? What's the opportunity cost if that tenant moves on versus all these little things, man, constantly assessing. What are your interest rates at? Speak to your broker. Can we negotiate anything down? If you're not constantly looking at your portfolio, you can't constantly assess and make these decisions. And again, this is where maybe do what Hung says and put it in there once a week. Worst case, you do it once a month. The best case, you do it, you're doing it 50 times a year, or you're at least doing it 20,
You're doing it more
25.
than you're doing it now.
100%.
And to your point about treating it as a business, your mindset framing it as business, you're not going to have a multi-million-dollar business that you don't check on.
100%.
If this is your day-to-day, you're not going to not check on it. Yeah. I want to take a little bit of a pivot, and I'll throw it open to the floor for both of you, which is the mindset of an owner-occupier purchase.
Yeah, I thought
this is a curveball. All right.
Hung asked me to say.
Yeah,
this.
no, we have to talk about this one because the big topic is rentvesting versus buying an owner occupier, right? And Sammy over here, he is the biggest advocate for rentvesting, 100%. Right? But what did Sammy do?
I just bought my primary residence a couple of months ago.
Why did you buy that primary residence? not without going into a super long version, but I
Yeah.
think we can summarize it pretty quickly.
There's a few things. There was an emotional play that came into it that was at play for me at that point in time. But then there's another thing. And in hindsight, I'm exceptionally happy that I did make that purchase. I rented for the first 7-8 years of my journey. Got to remember, I bought that property probably 15 and a half years into my journey. Next month is literally 16 proper years. November 17th was when I settled my very first deal in 2009. 7 to 8 years, I owned my own home. And then I realized that that was actually capping me from a borrowing capacity. Moved out, started rent vesting around 7 or 8 years ago. Wrote the journey and the borrowing capacity increased from being able to not live in your own home, which the banks, a lot of people don't realize the banks view your own home as a liability, not an asset, right? So your primary residence to the banks is a liability, not an asset, because it doesn't bring in income. Okay. Now, I embraced that for a solid probably 8 years when I really expanded and went crazy in my portfolio. And it was a really big lever that I had to play. My honest advice to anyone, like without a shadow of a doubt, if you can't afford your dream primary residence right now, plus build your portfolio, don't buy your dream primary residence. Go and rent it. The biggest thing is like a lot of the time a dream primary residence would be like $3 to $5 million, right? It might be more, it might be 10, 20 million, you might have massive aspirations, but for most people it's $3 to $5 million. $3 million primary residence is probably $1,200 to $1,500 a week to rent. $5 million primary residence, I was living in it before I bought this one. $5 million canal front, six bed, 3 bath, view, city skyline views with Broadbeach, all the rest of the sort of thing in the Gold Coast. $5 million primary residence, $2,100 a week to rent. That's $100,000 a year to rent that thing. It was something like $300,000 a year it would have cost to own it. Plus the $1 million deposit at 20%, plus the $300,000-400,000 worth of stamp duties. So I'm $1.5 million to buy this thing, $4 million worth of debt, $300,000 a year in repayments versus $100,000 a year to rent it. Now that's obviously like that's at a pretty high level of most people what they would pay for rent. But in all reality, you know, you could build a portfolio, get the portfolio churning, and then go from $1,000 to $1,500 to $2,000, which is what I did. But for me, then the pivot and the transition was, I realized that I had built my portfolio to a point. I had a huge amount of equity. I had generated a huge amount of passive income in my portfolio. I was already going to go through a sell down of roughly 20 to 30 properties in my portfolio to fund some massive commercial plays that I was building into the portfolio. And I did the assessment. I saw this house. It's a crazy story, the house side of things. I saw it less than 24 hours before I bought it at auction, which is a pretty short time frame for a $10 million plus purchase. But I absolutely fell in love with the house, went home, reassessed the portfolio, reassessed the sell down, realized I could easily afford it with the sell down that I was going to look to do to buy the commercial assets. And realized I could still continue to build my portfolio, still going to provide what I wanted, but also be able to afford to buy my dream primary residence. And that's what I reiterate the fact. You want to build a portfolio first. Like, just without a shadow of a doubt, build a portfolio first. Get the passive income churning. As a minimum, it will pay for that $5 million primary residence. It will pay the $100,000 a year to rent that thing. So that's a first. And then you can double down on the portfolio to build the equity base to be able to buy that thing in cash or very low LVR as well. So I firmly believe rent vesting is an unbelievable strategy. Even though I bought my primary residence, again, let's remember, boys, 16 years into the journey. I'm not a year or 2 years in. And I've got that many clients that are actually selling their primary residences, not based on my advice, or not me telling them to do it, based on my own journey, my own situation, people being in $1, $2, $3 million primary residences going, well, my dream primary residence is 5 or 10 mil. I'm not in that now. This thing is an anchor for me. It's a huge amount of debt, $1, $2 million worth of primary residence debt that does not produce an income. Going down this rent vesting strategy will allow me to massively blow up the portfolio.
So I'm going to jump in here.
Yes.
Because you always give me advice, and I'm going to put the shoe on the other foot for this. I feel like you get defensive over it. I feel like, you're always trying to justify it. But my point of this, because, you are an advocate of rent vesting, but from my point of view, it's like, if rent vesting's done its job, it's done its job.
For sure.
If you've had the lifestyle without anchoring yourself to a very big PPOR, it's done its job. And if you have every right to buy it, right? Because you followed it to the end. I think the alternative, and when we talk about rent vesting, like the three of us on these podcasts, it's, if you're a young millennial or you're a Gen Z in Sydney, okay, what's your alternative to rent vesting? It's, hectic. You can have a 70-meter apartment, 2 bedrooms in like Mascot.
Yeah. And you're still probably going to take on $1 million worth of debt.
Easy.
Yeah.
So it's like, well, that's not a life that many people want. Like, no disrespect, but that is a starter place. And if that's your starter place and you're looking ahead, it's like, well, I'm paying this off both my partner and I, and my wife and I, my husband and I, we're paying this off, and for the next 10 years, we're squirreling away. We've got maybe a couple $100, $1,000 at the end of the month in savings. You're not actually going to get investment property. That's not going to happen.
Yeah.
So for the rent vesting, for young people, that's the alternative. You can have a lifestyle which you hate. And once it's done its job, it's done its job.
Yeah. I'm with you, man. I don't so much get sorry, I'm going to just cut you there for a second, but it's not so much that I get defensive about it. I get passionate about it.
Yeah.
Because people have asked me about it before. I know Hung, like I didn't realize we're going to go down that avenue. It's not so much I'm defensive about it. It's passionate about it because of the result that it got me to. You know what I mean? And like, I love it, man. I love actually reflecting on it. And this is where like I was moving into the house and I was like, I wonder if this was the right thing to do. And then I've gone in there.
You second guessed yourself?
Yeah, dude, it was a huge purchase, man. I've never bought anything at that level before,
that
you know?
is true,
And
yeah.
it was massive. And it was against everything I'd ever, it kind of went against almost every grain in my body to do it, every fiber in my body to do it. But I think like the simple fact, man, is like the more I reflected on it, the more I was like, nah, this is like, if anything, this should be inspirational to people. Like, this is the journey I went down. It's the same thing that anyone can go down there and do. And I reiterate, build the portfolio first to provide the passive income, then build the portfolio to produce the whatever deposit you need or pay out the primary residence, whatever it is. I believe passionately about it, man. So it's a great, in my opinion, it is probably one of, we talk about all the different strategy pieces we were talking about before, and the different, you got to buy the right properties, you got to have the right structure, you got to have the right creative lending. But like this weapon in the arsenal has to be one of the strongest plays that you have.
Yeah.
One of the most strategic things you can put into the portfolio as a game plan.
Yep.
So I might share my perspective on it all.
Here we go.
So
it is your podcast.
I'll jump in here. I'll jump in here. But look, I'm a big believer in rent investing as well. So just note that before I state anything else.
I thought there's a but.
Right?
Yeah.
There is a but.
There's definitely a but.
You know, being a refugee myself, I've got this mentality of obviously always wanting to own your place. And I think I've shook that over the years, right? Really, it's a mathematics game. Let's be real. The one thing that Sammy did for a long time, and I also did for a long time, because we talked about this previously, is that we almost spend a dollar like it's our last dollar, right? It's almost like a survival instinct, and you know what a dollar's worth, right? And every dollar that you have, you know that you can turn that into another $5, $10, leverage that up, get more money out of it, right? So you're very cautious with your spending. Buying an owner-occupier, it's kind of like a luxury item in the sense, right? Because if you do quick mathematics, let's say you bought a property for $2 million, right? And let's say you borrow $2 million to make my numbers a bit easier, and then you're paying an interest rate of 5%. Let's just call it that, right? So $2 million mortgage as an owner-occupier debt, that is 200. Sorry, let me get this right. That is, let's say 5% per million. That's 50 grand. So it's 100 grand that you have to pay. Right, let's argue it's about $2 grand a week.
That's just interest.
That's just interest.
That's
correct.
Yeah.
That's just the interest.
Yeah.
So that's what we treat as rent, right? And then you've got obviously all the other bills that you have to pay, including council, water, all the other stuff, right? Sure. When you put that into comparison, and then you look at the numbers and you say, well, if I bought this house for say $3 million, let's just say, what do you think this property might be worth in 5 years' time? If you've done enough research, you know what, how the markets work, and do you think if you had $3.5 million or whatever it is, and you put it into another market, would you outperform that? And at the same time, people go, "Oh, but you're going to pay tax on it." But mate, tax, we got a special rule with a 50% CGT on tax, right? If you're buying in the right structures, and you look at that and you go, "Can I outperform it net of tax?" Absolutely, you can, right? But in saying that, I've always bought owner occupiers.
Yeah, I know.
So, but I say that because every time I bought an owner occupier, right, I bought in a growth market. So, as much as it's a thing that it's also a vehicle that will allow you to grow. Also, if you are buying in a growth market, you're not overcapitalizing, you know your numbers. Every single owner occupier bought would have produced 5 to 6% yield when I bought it. So they were rising at a pace faster than
they still
I could
stacked
invest.
as an investment.
They did. They stacked as both an investment as an occupier.
One of the other things I throw in there too is the other thing he's not even thrown in is like there's that mortgage piece, everything that comes alongside of it, but it's a retained borrowing or like the kill of borrowing that you have from it as well. So it's one of those things that a lot of people sort of overlook from that piece. They're like, oh well, like could you just outperform $3 million worth of property, $3 million, let's say worth of investment property versus primary residence property? What about the actual recycling and the velocity of money and the opportunity cost of being able to, like a $3 million primary residence, you probably with rental income could turn that into a $6 million investment portfolio over a 5-year window. You know what I mean? But with the primary residence debt, you couldn't because it's non-income producing. So, you know, the actual opportunity cost and then rate of return, you know, and return on investment when you work it out over that 5-year window, how multiplied is it by being able to recycle that debt and that equity back into the market?
Yeah. So end goal, where do you go from here? 200, 500? Where's the sky?
I'm gonna need a new poster of you. It's gonna say 1,000 property.
Oh, it's a funny thing, boys. I'm not really a numbers person anymore. I was when I was younger. It's a utility of what I buy. So when I look at markets, and I'm going through a sell down at the moment, so I'll drop back down from I think I peaked at about 140 odd properties, but I've been going through a pretty heavy sell down sort of phase at the moment. So yeah, man, it's an interesting sort of thing to look at and think about, but I'm not really, man. I'm in the game so much that I just keep buying. So like deals will come through, and I'm like, that has an amazing equity proposition on that deal, but it's too risky for a client to take it on. Almost all deals I buy these days are renovated deals. Too risky for a client to take on. I'll buy it. I'll run the risk. 8 to 9 out of 10 deals will be sweet. 1 to 2 out of those 10 will blow up, and I might break even, or maybe lose it, maybe make a little bit, whatever it is. But like that is a ratio I'm not really comfortable with a client carrying.
Yeah.
So yeah, man, I take those deals on myself, and I just still keep building the portfolio with that. I'm moving very heavily into commercial. I have such a large equity base within my portfolio. It's a natural transition now for me to transition into a more heavily commercially based and built portfolio now. So I'm buying some quite large assets. Again, the sort of things that a lot of our clients can't buy. So kind of like $5 million plus. I'm kind of shopping between about $5 to $25 million worth of commercial priced assets, which range from everything: medical centers, shopping centers, everything within that sort of
I
price
think you
point.
bought a shopping center last time I spoke to you.
Yeah, I did. Yeah. So that's sort of where I am. So I'll still continue to acquire resi, but I'm still exiting out of some resi markets at the moment as well. Some different things have sort of changed in play in the last 3 to 6 months too, that have made me decide to hold some properties longer than I was going to. So man, just constantly assessing, treating the portfolio like a business. I don't know where I'll end up in all reality. It'll be a portfolio value point. Maybe the portfolio value point over a period of time is 100 mil, you know, maybe 100 mil of, you know, that might be broken down between 30 mil worth of resi cash flow deals and 70 mil worth of commercial assets. I don't know how it'll play out, but I'm at a nice point in the portfolio now where it can sort of continue to self-generate and self-build. So I don't really need to sort of like strategically structure my portfolio, because it just keeps sort of like self-perpetuating now because of the level it's gotten to. So yeah, man, I don't think I'll ever stop building.
I actually firmly believe that you'll keep building. Where you end up, who knows? You know, I'm following the same path with you, my friend.
I love one of the first times we met, I'm like, oh, what is it? Is it the adrenaline of when you sign? You're like, no, I just do it now. I'm like, oh, okay. It's like, it's not the.
I don't get adrenaline anymore, man, out of buying deals. I actually get more adrenaline out of buying a mad deal for a client.
Yeah.
So I'll call a client and go, hey, man, I got this deal for you. I need you to sign it now. It's at X discount. Like you need to sign this thing right now. And they'll jump on, they'll do it straight away. But even whether it's a deal like that, and like that's an adrenaline hit, you know what I mean? Because they're excited, then you're excited, and you get the deal done. It comes together, boom, 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 boom. It can happen so quickly. But then you get other clients where you just like, it's a deal. We've got a little bit of time frame on it. Might be a nice, you know, $25,000 discount, something like that. You get in the portfolio. 3 months later, they got a, you know, 6 months later, they got an $100,000 equity release, and they're in tears, man, because it's their first deal and they just got an 80 grand equity release paired with 10, 20 grand they had left over. Yeah. They're buying their second deal after 6 months, you know, and like that sort of stuff, man. I get goosebumps from that stuff, man. In all reality, that's the stuff that still juices me up. Dude, another deal in my portfolio. It's another reno project. It's like, oh, is this one going to blow up?
It's another headache. Yeah.
It's just like, it's business for me. That's business for me. Whereas when you're changing people's lives and you're getting these results, and a deal comes across Hung's desk, he's like, man, that's a mad deal. I'd buy that. Like I love that stuff. That's the stuff we get to put in people's portfolios alongside the strategic piece that keeps building it as well. You know, we're fully committed to retiring people. We're fully committed to building wealth. We're not tick and flick. Like people might have seen ads for us for School of Property, because that's just the arm of business that is. You never see an ad for Australian Property Scout. We need it because of the recurring clients we have consistently building their portfolios, man. And that's what juices me up.
Now, I'm really glad you brought that up, because Hung wrote some questions for me. And to be clear, this was Hung's question.
Okay.
How is APS different from every other buyer's agent out there? I will let Sam have a yarn. something, and we'll give personal experience to give light as to why APS is by far number one in Australia.
I'll take that.
Is in the briefing notes that Hung gave me.
Okay.
Okay,
so you just want to distance yourself from calling me the number one BA in Australia.
Mate. Am I the one who's calling it?
Yeah,
You got to be diplomatic.
I'm going to be diplomatic. Anyway, so why are you number one in Australia?
Man, my honest belief is we genuinely care.
Yeah.
So we're a company built around investors, man. Like our company literally are all investors. Like there might be five people in the team that aren't investors, but they've got visions to become investors as well, man. And so like we build this methodology and this philosophy around investing and around winning in property, and we're not tick and flick, man. Like I say on our podcast, you guys are going to beat this, but if you're a dickhead, don't inquire with APS because I don't want you as a client. I don't want you as a client.
You guys have a pretty thorough sign-up
What?
process.
100%, brother. You know this.
Do,
Will knows this too, man. Like we do, man, because like I want to build, like we were talking about before, 10, 15, 20 plus property portfolios. I want to build that for someone. I don't want to do a deal. You want to come and test me, brother? There's 1,000 other buyers agents to go and test. If you want to come and work with us, we want to build you a 10, 20 property portfolio. Whatever it is that your goals are, that's what we want to build. I don't know anyone else that commits to it like that literally would turn a client away, not just do a deal because they're willing to come and do a deal. Literally jump on a call with APS. We will disqualify you. That's what we want to do because we want the people who are so committed to working with us because we know the commitment that we'll have to working with them. And man, that isn't normal. You know, but like Hung was saying before, I'm not wired normal. No, I'm not wired normal. I don't care if you're not the right fit. If we're not the right fit, that's sweet. We want to work with people that we genuinely can retire and want to go on the journey with us as well. And if that's not a fit, if you want to test, it's all good. That's sweet. But like, that's the mission that we're on, man. And like what I realized, dude, is like, we can't work with every investor in Australia. If I could have the choice between 1,000 investors at a deal each or 100 investors at, to be honest, 5 deals each. So 500 deals versus 1,000 clients at 1,000 deals with it. I will take the 100 clients at 5 deals because I know I'll scale those guys into at least another deal each and I'll get my 1,000 deals. You know, we'll do the 1,000 deals with that, but I'll do it with a significantly smaller group. Sorry, not 5. I'll take them to 10. You know what I mean? Like I know I'll get that result for them. Every day of the week, I'll take the 100, build to 10 rather than the 1,000 at one each or the 100 to 5. And I know I'll scale them into that next because we want to build relationships with people, man. I just want to work with good people and build amazing portfolios, man. You know what I mean? And the reason why is because I did it myself and I know how to do it. And I know the pain of being an average income earner in Australia and not knowing how the hell you're ever going to be able to afford that dream Ferrari or those things that you really, really want, or even just the financial security of knowing that within 10 years, I have the choice to work or not. If I want to work, I'll work. If I don't want to work, I don't have to work, all the rest of it. Man, I saw my parents work until they were 70, work on the farm until they were 70. And there was no one, like I'm so thankful that my parents could smell a rat more than I could because they had a chat to the BA that burnt me back in the day and they could smell a rat. Like they knew not to sign on with this guy. Man, so lucky they didn't, right?
Yeah, right.
Who is out there looking after, whether it's kids in their 20s, 30s, or whether it's people in their 50s, 60s, mate, who is out there literally looking after and wanting to see them succeed? It's one thing to say it, mate, actually doing it, hand-holding them through the process, celebrating their wins, getting goosebumps when they call you because they're up 80 grand on their first deal in whatever time frame. They pull it out, buy another deal. Who gets that, man? I don't know anyone else that does. Maybe there are some others that are out there. I say like now, maybe there are. There wasn't when I used to listen to other people. But yeah, man, I don't know anyone else out there that's that passionate about it and actually wants to see it succeed and want to see those people actually get that success, regardless of where they are in life. Because man, I've been through that many years to know what it's like to not think that there's something bigger and better or that it actually isn't achievable. And I've seen enough people do it. I saw my parents do it. I don't want that, man. For the average Australian, if we can help change people's lives, mate, that's what it's all about.
There's going to be a lot of people.
That's why I still do this, man.
There's going to be a lot of people listening to this podcast that, you know, that they see the new era of buyer's agent come through. And I mean new era, I'm talking about even a lot of people that have come on board over the last 24 months, right?
Sure.
Because every time I scroll through Instagram, there's I mean, and some of the advice that they're coming up with, I'm like, that is not cool to be giving really bad financial advice like that, or just, you know, like giving. Anyway, I'm not going to go too in depth. But what would you say to people out there that are kind of flirting with some of the new buyers agents that have come aboard that haven't gone through this journey, that don't actually know, even like what we were talking about with Hung before, they don't have an understanding of the financial aspects of it.
Man, I don't want to shit can anyone out there. In all reality, man, we stay in our own lane. We do our own thing. I literally don't, as I was saying before, I don't even know what other people talk about anymore. I don't care because I know what we do works, and I'm always looking to pivot if there's a different market or a different product. It's like when we pivoted into commercial because I knew that the residential cash flow deals were dipping and we were reaching a compression point. I knew we had to pivot into that, so I brought things in that I knew were going to be able to facilitate needs for our clients. So man, I don't listen to anyone else's stuff, right? But in all reality, man, like. You have to work with someone that has done what you want to do. Whether it's a broker, whether it's an accountant, whether it's a buyer's agent, whatever it is, you have to work with someone who has done what you want to do. Otherwise, how are they going to help you hit your goals? How are they going to help you hit and do what you want to do if they haven't done it themselves? Yeah. It's as simple as that, man. Like, you wouldn't go to a business coach if you were trying to get to, or if you were an Olympic athlete or you were trying to be an Olympic athlete. You don't hire, like if you're a professional athlete but you want to go Olympics or something like that, you don't hire the dude down at the park who's just running his first PT session. Yeah. You don't hire that guy, right? Yeah. Do you? You hire the Olympic coach that's retired, that's now doing it at private practice because he can make more money. You hire that professional that has done what you want to do. And this is where I talk about the broker side, man. I went through 7 brokers before I found my broker. 7 brokers, man. Because, dude, I was a low income earner. People didn't know how to do it. Yeah. Accountants, same thing. I went through so many accountants. So I found the right accountant to fit it. Like I look at a lot of people, a lot of clients that come to us now. They've been through a lot of buyer's agents before they find the one that the synergy's there with that they know is going to build the portfolio. Man, it's very, very simple. You only work with someone who's done what you want to do. It's as simple as that, man. Because if you want someone to be able to take you down that pathway, and like buying a property, yeah, sweet. Like whether someone can buy at a discount or can't buy at a discount, which 99% of buyers agents in the country try and say it's a fugazi to buy below market value because they don't know how to do it. Yeah. Right? 99% of them say it. We've seen it. Like we've called people out on it before. It's a very simple fact, man. Regardless of whether they can buy at a discount or not, it's like, can they help strategize a portfolio to go to the different level it is? And that's why Hung said earlier, when people come into APS, we have a non-negotiable now to go through School of Property because for us, that educated investor becomes a significantly easier client to work with and an easier client to scale their portfolio because they understand it. We're not needing every strategy to run through an hour around creative lending or an hour around how we're going to do all these different things because they understand that piece of it. We're now just formulating that strategy specific to that individual because they understand that piece. The more educated the investor, the quicker the journey, the better the results, the faster the results. And like we were talking about before, the faster you can achieve a significant gain, significant result, the quicker that can compound and can build to a different level as well. So you have to you have to stack the deck. Yeah. With education is so important. But like with your dream team that we were talking about before, broker, accountant, BA, and stack the deck with education. You have to stack the deck to win, man. No different in anything. Are you gonna stack the deck with the guys that have no experience or the guys that have done it and done it for other people? You know, so that's how I view it, man.
Do you have anything to add given this was
no, given this podcast,
given I you want to give some personal experience to give light as to why APS is number 1 by far.
Look, Sam's spat a lot of fire there, which is great.
You're welcome.
The fire-breathing dragon, love it.
Nothing else to add.
No. I still got things, but no, look, coming, I guess, from the back end of that, a lot of APS clients that we look after, we find that they're super educated. It's no longer a matter of, what's the interest rate? Yeah. What's this? They're not questioning our judgment, which I love about the process. They're basically going to APS and saying, buy me in Timbuktu. They don't even know where they're buying, to be honest. They're just like, hey, where are we buying? Or at the end of the day, what makes the most money? That's what it comes down to. But what's going to help us then further build the portfolio in this sense? So I find that, really refreshing. So every time, even my team, every one of the brokers are like, man, so much easier dealing with APS clients than anyone else out there because they've been through School of Property. They've got themselves educated. They know exactly what they want and they've built that trust already. So that trust is the hardest thing.
Strategist within there as well.
Yeah, 100%. So I'll probably add that to the piece there. Further than that, I think, Sam's just, his passion for helping people really resonates with me personally also because that's what we believe in first and foremost. We don't count numbers. We don't count settlement figures. We're not out there telling everyone, oh, yeah, I'm biggest guy in the world. We're all about, are our customers satisfied? Are we really, changing their lives and helping them build out something that's going to give them that freedom one day? And that gives me goosebumps and makes me tick also. So the combination of us doing it together, it's amazing.
Yeah, unstoppable.
One thing I'll throw in on that as well. I mean, I love that humble side. A lot of people in the industry on both sides, both from a broking and BA, everyone loves to shout their numbers to the rooftop. And it's a funny thing because neither of us do it, right? And I'm going to give you a shout out here, Hung. Like Hung this year will do over $1 billion in settled sales as a brokerage. Mate, that is almost unheard of. Like there's almost no one that writes at that level, right? Almost no one writes at that level. And the guy he doesn't even go out there and talk about it. You know what I mean? Like every other broker loves to shout everything. Every other BA loves to throw all their numbers out. It's like, mate, you know what? It's not a swinging contest. You know what I mean? Like it's do a great job, be good people, and help people continue to build it, mate. The rest takes care of itself.
Yeah, we actually were talking about this before we started recording. I was talking to Hung outside when we were waiting 20 minutes for Sam.
And that's quick, man. That's quick. You're welcome. You're welcome.
He was an hour and a half late last week.
And then Hung was talking about one of your guys, one of your team. They're doing a deal every day.
Yeah.
And I was like, and we're looking at the numbers. I'm like, surely that would make him one of the biggest brokers in the country. Oh yeah, something like that. Yeah, it is. There is the humility, right?
It's just business as usual, man. You know what I mean? Like we don't. This is the thing, mate. We don't focus on. It's the same as both of us. We're not focusing on because we know we're going to get paid well if we do a great job and everything goes through kosher. You know what I mean? Like we just that's our philosophy around it, man. And I've built that many stop points in our team, in our system, going through with deals that a bad deal can't go out. You know, because it obviously got to a point where like I couldn't look over every single deal that went out at APS. So I brought in like a 3-step valuation and stop process. They got literally 3 sets of eyes that due diligence and valued the deal before it went out. Because that was me. I used to watch every deal so closely, so tick off every criteria that I was very comfortable with it.
Yeah.
So then it got to a point where like, I mean, there's other things in the business that obviously are such a much higher priority for me to focus on. But if I could build in that 3-step process, the 3 different sets of eyes, value and due diligence on this deal, I feel comfortable with that. Yes, that incurs a cost that's significantly higher than me going through and looking at it from that end as well. But it's that thing that gives me the peace of mind of it going out. And I think, man, it just flows in of like the great results. You're going to end up with the result from a financial perspective anyway on the back end. We don't care about it, man. We're just like, we're focusing on doing the right things because we know that comes off the back end anyway. You know what I mean? That it just takes care of itself by doing the right jobs by everyone and just doing business as usual, you know?
Yeah, 100%. Now, one big question on everyone's minds out there to wrap up the potty, throw this open to both of you.
Here we go.
Is there still good opportunities out there to buy?
Well, maybe I'll start first because Sammy will get fired on this.